Well, the U.S. is shifting away from using coal to natural gas, and one company in the middle of this transition is Dynegy. And earlier I had the chance to speak to their CEO, Robert Flexon, and I asked him about what he sees, what he thinks when he sees this big slide in oil and natural gas prices that we saw today.
Well, for us, power is generally priced off of natural gas, so if natural gas is falling, it drives power prices lower, which is generally not a good thing for us.
And what does that mean? That you make less money, basically, when natural gas falls?
Right. Your power prices go down, and so as we sell energy into the wholesale market, we're selling it in at a lower price. And what we've seen recently, in like the past week or so, the combination of no weather, no real hot summer weather in the Mid-Atlantic and in the East, and the fall off of gas prices and the like, we're seeing incredibly low power prices, the lower power prices, so the lowest power prices I've seen in quite some time.
And your product mix is natural gas and coal. They sort of in some ways compete against each other. What is your outlook for prices?
Well, for prices of natural gas, I think with the amount of supply in the market, it's going to be range bound for the next few years. We have gas assets, our gas generation assets tend to sit right on top of the gas reserves in Marcellus and Utica. So we tend to buy gas lower than others, so that softens the blow for us. But the general outlook longer term is that the gas prices are going to be range bound while the supply continues to exceed the demand. I think it's going to take until you start exporting natural gas, until you start using LNG, shipping it abroad, and higher power burn using natural gas as coal plants retire. That'll help the supply get soaked in by higher demand.
And the other issue, of course, is as natural gas prices fall, it becomes actually more attractive for the end user, which means that coal is less attractive. How do you hedge this play when your product makeup is both of those commodities?
Well, you're right. There's somewhat of a built-in hedge in our portfolio. When the gas prices come down, our gas assets can do okay, offsetting what our coal plants use. And when gas prices go up, that's when our coal plants really become in the money, which illustrates kind of the natural hedge in our portfolio. But what you need to do during these time periods is that you have to hang in there, manage your costs as well as you possibly can, and recognize that there's other dynamics happening in the power markets, that it isn't just about natural gas anymore. You're seeing a dramatic decline in supply of generation assets, and that's going to drive higher capacity prices, and more expensive units are going to start setting the price for power. So that offsets the decline in natural gas to some extent.
Now, you have said in the past you have about $1.1 to $1.2 billion for capital allocation over the next 2 years. What's the relationship between a capital allocation plan and commodity prices?
Well, certainly we have our portfolio is largely open, so as power prices come down, it would actually reduce the amount of capital we have to allocate, and certainly if power prices go up, you have more to allocate. But as I said before, there's a little bit more than just gas prices that are going to drive that cash flow generation that we have. It's going to be the retirement of assets. It's going to be capacity prices that are being set in the PJM and the New England marketplaces that are going to drive a certain level of revenues that gives us that capital to allocate. But certainly, higher natural gas prices will certainly help that cause as well.
And another part for focusing on your business is coal. The Supreme Court really gave utilities a break at the end of June, ruling against a law that would have forced companies like yourself to close some old coal plants or really pay up to make them cleaner. Did that make you rethink any coal strategy, sort of put more plants online, not take plants offline?
No, Alex. We retired our uneconomic plants, or our plants that would need so much of environmental expenditures. We retired them a couple of years ago. We're actually supportive of the MATS rule and requirements. And I think one of the difficulties in being a power generator in the country is that these rules come in and they go out. And you think about power assets, you're talking about assets that last for years, and you make billion-dollar investments into these assets. And with these rules coming in and coming out, it makes it quite difficult actually to plan for the future. But for us, we have the portfolio that's environmentally compliant. We would like to see the MATS rule in place. and kind of move on, and let's focus on the future and not keep going back in the past. So we actually find it disruptive to the business that these rules keep coming in and coming out.
And talking about the future, on days like today when you see nat gas plummeting, are you rethinking a renewable strategy? Or are you like, man, I wish I had some wind in my portfolio?
The basic premise for an investment in Dynegy right now is that we are in the power markets that you want to be in. And between the environmental rules and the low natural gas prices, you're seeing a lot of retirements. Supply is getting tighter and tighter. And what you'll see the second half of this decade, the next few years, is you're going to see power prices go up because the supply side has gone down and the rules around how do you get capacity payments are tightening up. So for those that have products that they've been selling into the market that haven't always performed, you now get paid for the quality of your assets, and that's going to really be a benefit to us in the years to come.